Borrow, spend, die. That's the financial strategy of some of the richest people in the world. When you hear about billionaires, names like Elon Musk, Jeff Bezos, and Mark Zuckerberg often dominate the conversation. But people often point to the fact that their wealth is illiquid, because if they sold a substantial amount of their shares, the price would crash. If their strategy was to sell their shares, that would be entirely true. But the reality is, they have a different way of accessing their wealth. Borrow, spend, die is a three-step process, allowing the wealthy to minimize taxes and maximize wealth retention. The process is simple. First, borrow against the value of part of their net worth. Use that to fund daily expenses. Borrow further to cover interest payments. And finally, die. This method of wealth preservation's main benefit is avoiding taxes. When you borrow, none of what you borrow is taxed. The only real cost is interest. When you have money in the hundreds of billions, like Musk or Bezos, even if your life is extravagant, you can't realistically spend it all in your lifetime. To put even $1 billion into context, if you earned $10,000 an hour, worked all 52 weeks of the year, it would take you nearly 50 years to reach just $1 billion. It's a paradox. The ones who need a loan the least get the most. Lenders like the low risk of high net worth individuals and give them the most favorable rates. So it's safe to say that they could basically kick the proverbial can down the road into perpetuity, borrowing millions here and there to fund their lifestyle. When they die, they also benefit from a favorable tax system. Federal exemptions allow for nearly $14 million to pass untaxed. Anything over this limit is taxed at a marginal rate, from 18% for the first 10,000 to as high as 40% for the next million. When these assets are finally passed over to the next generation, they receive what's called a stepped-up basis, essentially canceling out capital gains by valuing the asset at its current market price and ignoring the appreciation prior to its inheritance. This means that for inheritors, selling the asset would also result in no taxes. If you look at the system on the outside, it's clearly designed to benefit the wealthy. Wealth accumulation and wealth inequality has accelerated in the past 4 decades. The neoliberal approach of promoting free markets through lower taxes for the wealthy and corporations has significantly harmed wealth distribution. Through cuts to the top marginal tax rate, we now have stagnant tax revenues relative to national income. When you have this, your ability to pay for social services like healthcare, as well as basic repair costs for infrastructure, gradually decreases through inflation, because things get more expensive as the government borrows more to meet its deficits. But this is further exacerbated by the fact that these countries are getting older, with inverted population pyramids, and more old people to support in terms of healthcare and other costs. What happens is that your governments are less able to fund basic services and are forced to decrease either quality or quantity of services over time. With something as basic as an American university education costing an entire inheritance, France changing its pension age, and the UK's NHS's persistent underfunding. This kind of system of decreasing taxes has allowed the generations of the past, from the 50s and the 60s, to accumulate these vast fortunes at our expense. Because at the time they were able to pay less taxes, they were able to take opportunities away from us by buying out large sums of property, and are the same ones jacking up prices through the corporations they run. They benefited from a time where the cost of living, both housing, education, food, and so on, were at a much, much better ratio to what you could reasonably make at any job. But those same generations took advantage of that power and that opportunity to make sure that the world they inherited was exclusive to them. Between 1944 to 1963, the richest Americans had a top marginal tax rate of over 90%. Yet the economy still expanded and opportunities were abundant. Now, CEOs are richer than ever, and the average worker barely makes rent. Estimates put the growth of CEO pay at 1,085% since 1978, compared to a 24% increase in average worker pay in that same time period. Most of these increases in pay have, unsurprisingly, been stock-based, stock options and awards that allow executives to avoid taxes until they sell and realize those gains. You could argue that this arrangement aligns incentives. Executives are inclined to work to the benefit of the company. Most of the time, this means growing margins or net income. Board executives, also major shareholders, perpetuate this further by continuing to fund this system of compensation, creating this infinite loop where CEO pay continues to rise so long as the bottom line and stock performance continues to improve. But if you really think about it, this leads to several behavioral distortions. The value of stocks comes in part from its scarcity. So increasing the supply, all else equal, is essentially enriching the options holder at the expense of all other shareholders. Besides this, if the CEO knows that their pay is tied to enriching shareholders through the bottom line, it gives them every reason to cut costs. Take it this way, the ways that you would make a company more profitable can generally be boiled down to raising revenue or cutting costs. The first comes through business expansion, but nothing expands forever. So in downtimes, costs are cut. It leads to a lot of short-term thinking, with mass layoffs happening even when the company is doing well financially. You can see this phenomenon happening especially often in the past few years. You have companies like Visa and Google, where despite record-breaking earnings, they seem to always be hedging against a recession, laying off employees to trim costs whenever they can. All this results in is adding more churn to the job market for the sake of eking out a little bit more profit that quarter. At the same time, you have consulting companies like EY pushing back start dates for their new classes of hires, reducing the availability of new jobs for the next year, while also leaving those delayed waiting for their paychecks. Adding to this is the fact that stock buybacks, spending company income on repurchasing its own stocks, was illegal before the 1980s. Buying back stocks only served stockholders, increasing the value of their shares and diverting funds away from company salaries or capital investments. The world we have now is stacked against the common person, and heavily structured in favor of company owners like these billionaires. A lot of us younger generations came into this world being told about the opportunity in these Western countries. But if you look at the data, the Gini coefficient of all these countries has significantly decreased from the 1980s and not come back down. What I'm certain of is that if we want to return to a more equitable world, one thing we need to do is revisit how we design our tax systems. We need more marginal tax rates, higher thresholds past $600,000. There's no reason your successful surgeon should be paying the same amount on an extra million as the person who's clearing tens of millions a year. You could have new thresholds at intervals like 1 million, 5 million, 10 million, and so on. The specifics don't matter. At the same time, we need a tax on wealth, some way to break the avoidance scheme of being able to borrow against your assets, hiding behind charities and trusts, and being able to tax people's net worth to some extent. Put it this way, the wealthy families and billionaires among us benefited greatly from the societies around them. To have them then go and shield themselves from taxes, essentially being a class of parasites that take so much but give back nothing, is a betrayal of the very social contract that allowed them to accumulate their wealth in the first place. The rise of these billionaires and their system of borrow, spend, die was only possible by failures of generations of policymakers to reverse and reject the idea that unfettered capitalism will always be exploited. Ronald Reagan's concept of trickle-down economics, that savings for the rich would drip down to the poor, or Margaret Thatcher's series of privatizations in the UK, was a complete farce. And yet we continue to allow ourselves to continue to be exploited today. What we need is a change, and we are reaching that breaking point. It's not a matter of if, but a matter of when.